Good morning and welcome to Capital Sound. If you woke up to news of a short ceasefire deal between Washington and Tehran and saw oil sliding while futures perked up, you're not alone in thinking, is the market celebrating a real de-escalation or just taking a breath? That's the tension we're unpacking today, and it matters for how your trading day might open and unfold. I'm Mandy Prince, and I'm joined by Charles Sterling, our resident multidisciplinary thinker with a knack for turning a headline into a decision tree. Charles, ready to spar this out?
Ready and caffeinated, Mandy. This one deserves a split screen.
Perfect. Here's the debate. Do you treat the overnight ceasefire news as the start of a relief cycle, lower energy fears, better risk sentiment, or as a temporary pause that leaves markets underpricing the next curveball? Asia rallied, Europe's pointing higher, oil's lower, and US futures are brighter. But we've also got questions about Gulf oil infrastructure and whispers of stress in short-term credit. So let's frame it cleanly. What's at stake for today's session?
The stakes are simple but not small. Energy feeds into inflation expectations. Inflation expectations feed into rates. Rates feed into everything from tech valuations to borrowing costs for consumers. If the ceasefire sticks, you get a pressure release. If it doesn't, you get a quick return of the oil premium and tighter financial conditions. Today is about whether traders treat this as a real regime shift or just a temporary reprieve.
And it ties back to that thread we've been tracking, oil pushing up against a world where yields have been drifting lower, which has felt like a mismatch. We've been calling it a possible stagflationary regime shift, and now the market's getting a headline that could either confirm or unravel it.
Exactly. If oil fades, that mismatch eases. If it doesn't, that theme is back on the table in a hurry.
Let's structure this as a proper debate. First, the bull case. Why might the market be right to cheer the ceasefire and assume it changes the near-term playbook?
The optimistic case is straightforward. A ceasefire, even a short one, reduces the immediate probability of supply disruptions. That's a direct hit to the risk premium in oil. If oil and related volatility come down, the market gets breathing room, and risk appetite can expand for at least a session or two.
Translate that into today's trading lens. Who benefits early in the day?
You would expect a tailwind for sectors that hate energy spikes: transportation, airlines, consumer discretionary, and parts of industrials. If energy costs look more manageable, the travel complex tends to breathe easier. Also, high-duration tech can catch a bid if rates and inflation fears soften, and small caps may get a quick pop because they're more sensitive to domestic sentiment and input costs.
That's the relief rally interpretation.
Yes, and it's aligned with pre-market mood. The market is a headline-reactive animal in the morning. A calmer headline can be enough to lift indexes, even if the medium-term picture stays complicated. Assuming rates don't spike, the narrative becomes risk is fading, let's re-risk. It's not deep philosophy, it's traders pressing the easy button.
That's one risk acknowledgement, and it's a good one. Keep going. What else supports the bull case?
The market has been on edge about geopolitical spillovers. Even a pause gives funds and corporates a chance to re-engage. It's also a confidence nudge. If you strip out the drama, a reduction in tail risk tends to raise valuations, even if just temporarily. And the tech complex has been searching for any justification to stabilize after a choppy stretch. A calmer energy story can be that justification.
What about the defense headlines floating around? There's talk of a massive future budget proposal. Does that add to the risk-on narrative?
It could, but I'd call that a policy overhang rather than a catalyst. Investors might nibble at defense names, but the larger effect is just a reminder of fiscal realities. That's not a clean positive or negative today. It's just a background hum.
So bull case is ceasefire cools oil fears, risk premium shrinks, and money flows back into rate-sensitive areas and consumer names. That's the morning rally play.
That's the simple version, yes.
Oh, now let's flip it. The bear case, why might the market be underestimating the fragility of this setup?
The short answer is that a ceasefire is a pause, not peace. It's conditional, it's short, and the physical risks haven't vanished. There were reports of damage to critical energy infrastructure in the region. That doesn't unwind overnight. If you think in second-order effects, shipping risk, insurance cost, and route disruption don't clear just because a headline flashes.
So the oil premium could reappear quickly?
Exactly. And the market has a habit of treating pause as problem solved. That's dangerous. If oil does pop back up, all those rate-sensitive trades look fragile. Plus, Reuters flagged early signs of strain in short-term credit. That matters because it's the financial system's plumbing. If the pipes creak, equity optimism becomes a nice story without much follow-through.
That's a good point. We've been talking about central bank credibility concerns, and that's another part of the bear case. If energy risk flares again, central banks can't just shrug it off.
Right. Central banks can't declare victory on inflation while energy remains a live wire. That keeps the hurdle rate high for equities. Add the ongoing thread about mechanical selling, those volatility-targeted strategies that de-risk quickly when volatility spikes, and you've got a market that can turn on a dime. A little turbulence in oil or credit can cascade.
Let's bring in a specific company angle. There's a piece on Apple that highlights aggressive supply tactics and valuation concerns. Does that matter today, or is it a side story?
It matters at the margin because it's a reminder that not all big tech is cheap or immune. If rates remain sticky or drift higher, high multiple names can wobble. Even if Apple is operationally strong, valuation sensitivity remains. That's not a crisis, it's just a weight on the everything rallies narrative.
So the bear case says temporary calm, underlying infrastructure risk, financial system stress in the plumbing, and valuation sensitivity in mega cap tech.
That's the gist. The market might be a little too eager to shrug.
Now for the cross-examination, I want to challenge both sides. First, on the bull case, what would genuinely make you believe the relief rally has legs beyond the open?
I'd need to see more than a price reaction. I'd want to see oil stay lower into the U.S. session and credit spreads remain calm. If that changes, so does the thesis. A relief rally that's just a futures pop is fragile. A relief rally with calmer energy and stable credit looks more durable.
And on the bear case, is it already priced in? Investors have been nervous for days. Could the market simply be exhausted from fear?
That's fair. There's a lot of caution priced in, and positioning could be lighter than people assume. If the ceasefire holds and oil stays soft, the bear case loses its bite. I could be wrong if the energy market truly settles and the news flow stays quiet for more than a day or two.
That's two different risk phrases, and I appreciate the precision. Let's go further. Where do you actually lean today? And with what conviction?
I lean cautiously toward a tactical relief pop that fades into a more mixed session. My conviction is moderate. I'm not calling a melt-up or a breakdown. I'm saying today looks like a tug-of-war between headline relief and structural caution. The one thing that would challenge this is a sustained drop in oil that brings rates lower in a credible way. If that happens, the risk-on tone might persist longer than people expect.
That's your third risk acknowledgement, and it's distinct. Good. Now, how do you translate that lean into what listeners should watch today?
Watch oil first. It's the barometer for this narrative. If it stays down, the relief rally case is alive. If it bounces early, risk assets could wobble. Second, watch short-term credit and funding tone. You don't need the exact numbers. You just need to see whether the stress chatter escalates. Third, watch the rate-sensitive sectors. If they can hold a bid past the first hour, it means the market is buying the de-risking story. If they fade, the market is still skeptical.
That's clear. I'll add a sector angle for the audience. In a relief, leaning open, transport, leisure, and some consumer names could look active, while energy might lag. If the mood turns, energy and defense might regain traction, and the rest could cool. Does that match your framework?
Generally, yes. I would add that banks could be a tell. They're sensitive to the credit story. If bank stocks shrug off the credit stress headlines, the market's in a look-through mode. If they underperform early, it's a warning sign.
Let's rewind to the idea of money moving from one part of the market to another. We've been seeing rotations that are fast and sometimes contradictory. How does that play into today?
It makes today's red tricky. This is a market where nothing is moving together anymore for long. A morning pop can be a different story by lunch. That's why I think today is less about predicting and more about monitoring the signposts. Oil, rates, and credit tone. Those are the gravity points.
The debate nature here is real. On the one hand, we have a visible de-escalation headline. On the other, the deeper system risks haven't vanished. So here's my gentle pushback. If the market is always on edge and you always wait for confirmation, don't you miss the upside?
You do miss some upside, and that's okay. My philosophy is more about avoiding stupidity than chasing brilliance. If the upside is real, it tends to last longer than one session. If it's a head fake, you don't want to be the one last in. That's not a trading instruction. It's just a temperament. Today's setup is a great example. The headline invites optimism, but the scaffolding is still shaky.
That's classic Sterling. For listeners preparing for the day, let me summarize in my own words. We're looking at a potential relief rally sparked by a ceasefire headline that pushes oil lower. The bull case says that lower energy fear supports risk-sensitive sectors and gives tech and consumers a boost. The bear case says the ceasefire is conditional, the physical risks remain, and short-term credit stress could reassert itself, making any rally fragile.
That's accurate and tidy.
So let's go into resolution mode. Charles, if you were advising someone on how to read the day without giving trade instructions, what would you say?
I'd say treat the open as a referendum on fear, not a referendum on fundamentals. See whether the morning optimism holds into the afternoon. If it does, it suggests the market is willing to downgrade the geopolitical risk premium. If it fades, it means traders are still pricing for uncertainty. Watch oil and watch credit. That's where the story will be validated or rejected.
I like the referendum on fear framing. It's a clean way to think about the day without making it about a single stock. We should also remind listeners about those ongoing threads, central bank credibility, and the mismatch between oil and yields. If this ceasefire helps unwind that mismatch, the whole macro mood improves. If it doesn't, we're back in the same unresolved tension.
Exactly. This is one of those days where the headline is the spark, but the fuel is macro. The spark alone doesn't burn if the fuel is damp.
Before we wrap, one more question. Are there any specific data points or events you're watching today that could tip sentiment?
It's mostly headline-driven today. Any update on the ceasefire or shipping lanes will move the energy complex. Beyond that, it's about market tone. Do risk-sensitive sectors sustain gains and do defensive names lag? That tells you whether the relief story is being believed.
So our map for listeners is watch oil, watch credit, watch the sector tape. If the relief holds, today may feel constructive. If it falters, we're reminded that the geopolitics are paused, not solved.
That's it. Reasonable people can disagree, and the market might disagree with itself by lunch.
I'll take that as a warning and a smile. Charles, thanks for the debate. You always keep the thinking crisp.
My pleasure. I'll go be wrong in private like everyone else.
That's the spirit. To everyone tuning in, thanks for starting your day with Capital Sound. Keep an eye on those signposts we discussed and take the news flow with a clear head. We'll be back with you later. For now, from Charles Sterling and me, have a smart trading day and goodbye.